Hey there, Brian Bachner and the most amazing Gregory Towner here with us today, Parallel Portfolios. It's time for our July edition of Five Charts in 5 Minutes. It is July 4th week. It is the middle of summer. I know there's a lot of people at the beach or doing some fun stuff, and this is probably some of the last thoughts on your mind here, but the market is still trading. Things are still happening here at Parallel. We're still on it. So we're going to take the next 5 minutes and talk about it with you. Greg, let's take it away.
Yeah, absolutely, Brian. Let's start off with a 3-year look at the S&P 500. And we can see here on the right-hand side, it's exploded higher recently. Remember last year, everybody was late last year, early this year, everybody wanted to get into, money market accounts, paying their 4%, 5%. And that's great. I understand that. But what they didn't see was that the market had started moving higher. Sentiment was really negative. And despite that, or probably because of that sentiment, market has moved up nicely. Now, what we've put on here is these black horizontal lines. We've been talking for probably over a year now that we think the market could be in this wide trading range for quite a while. And so far, that's held true. You can see now we've moved above the halfway point of that trading range. But, as we always tell investors, stay open-minded to different
Mhm.
outcomes. There's no guarantee that the market is just going to miraculously stop at that black line.
Right, right.
It may not get there, or it may just blow through it and keep going. So we're staying open-minded to various outcomes, but our base case is that the market still tries to trade sideways in that. But under the surface, Brian, we think there's going to be a lot of rotation. And we've seen growth stocks do really well and push this market higher. I think there could be some rotation to value stocks or different industries and sector groups. So there's always going to be opportunities under the surface, regardless of if we stay in this range or not.
Yeah, let me just interject. I think one of the mistakes to make in looking at this move right here, and I'm already hearing it from some of my clients, is to think that like, oh yeah, because you hear us say this all the time. The next 10 years are going to look different than the last. And so you're right. There is some growth in tech areas that are moving this forward, but you need to be very careful to think that, well, that's, if we go back the last 10 years, that's what drove the market. We're seeing there is a lot of rotation. There's a lot of things happening. Interest rates are higher, which I know you're just about to talk about, but things are likely looking different during this time for sure.
Yeah, absolutely. And I think a big driver of that could be what happens with interest rates over the
Right.
next, say 6 to 12 months. This is a look at the 10-year yield. It's been trading in a pretty narrow range now for quite a while. Of course, nobody knows for sure which way it's eventually going to break, upside or downside. We're leaning maybe towards the upside, but it's hard to say. But what we do know is that this will have a number of repercussions on a lot of areas, but particularly or including the economy.
Right.
And so, what's going on in the economy right now? We talk a lot about the service economy. We all know everybody's still traveling and eating out, and that area is booming. But what people are just now starting to realize, this is the construction that's being occurring in the manufacturing sector. Look at this. This is a 20-year chart. It's exploded higher this year on the back of the various legislations and the reshoring, the supply chain coming back to the
Right.
US, that sort of thing. So all this is combined for a massive move higher in construction spending, particularly in certain areas. It's helping the industrial sector. It's helping certain parts of the materials sector. We think ultimately it will be beneficial for a lot of different areas of the market once this is built out. So really key growth to the economy. So that's kind of where we sit, market and economic wise. But we always like to take kind of bigger picture look at the market, step back a little bit, and give people something to really think about. This is kind of a distribution that looks at the market's returns in each calendar year and what is it up or down in a particular period. So this big column in the middle shows us that about 50%, 57% of the time, the market is up in any calendar year, 10% or more. So pretty nice.
Hmm.
So we work our way to the left, 37% of the time, the market is up 20%, really
Right.
nice.
Right.
19% of the time, the market is up 30% or more, really incredible. So let's compare that to the column on the far right. About 12% of the time, markets are down 10% or more. Remember last year, Brian, the market was down more than 10%. So the market is up more often, more than 30%
Right.
than it's down
Right.
10% or more.
Right.
And the market is usually up. So people tend to remember the bad down years or the bad, periods within years. But the reality is, more often than not, the market is having really good years by and large.
And this is 94 years of data here. This isn't like just something recent or anything like that. 94 years of data we're looking at.
Yeah, and then we also, we talk a lot about avoid the noise, avoid the short-term mindset. Well, we're going to put it into some numbers here for you. So this is the percent of likelihood that equities drop, so decline in stocks in 1 day period on the left, 46% of the time, 46%. So it's just basically a coin flip. Stocks may be up or down in a given day. And as we go down in time period or up in time period down the chart, maybe 1 year, about a quarter of the time, you'll have losses. But as you go down to a 10-year time frame, only about 6% of the time, this goes all the way back to 1929, will you have a loss. That means 94% of the time you'll have a gain in stocks over 10-year time frames. So this is one of the many reasons we talk about
Right.
focusing on the long term and avoid the short term noise, because the short term is just so random. It's almost impossible to know.
Yeah. Yeah. Well, that's good. So, stock trends are up. We know there's a lot of money in money markets right now earning 5%, and that's good. And if that helps you sleep at night, by all means. But there is some opportunity. We're certainly seeing some opportunity. And again, we may be in a range bound market, but that doesn't mean there's not some decent places to invest in. Yields, like you talked about, obviously are driving a big part of this. We're stuck in a range here. It'll be interesting to see here over the next few months if they break out or break down, and how what that does there. We are seeing that strong economic health, like you said, construction and service, especially in the construction side on the industrials. And if you really think about it, all the supply chain issues we had from COVID, from China shutting down, every company out there right now, worth their salt, is trying to either onshore or move or do something with their manufacturing situation, so they're not stuck in that issue again. And a lot of it is now coming back to the States, and that's good, and that's positive. That creates jobs, that creates just so many things, not only on the construction side, but there as well. So it's huge economic driver there. And we'll go ahead and just close with this last point here again. We got to focus on the long term, and we get so focused on the headlines and the media, and that's all very short term noise. But we got to focus on the long term and stay in the game. If you got a question, you know where to reach us. Phone number, email address. Happy to answer your questions. Talk through any specific issue with you. And thank you so much for tuning in to this month's 5 Charts in 5 Minutes. We'll see you next month.